we're going to make you an expert on financial ratios.
The first thing we need to understand is that ratios are used for comparison. Without something to compare it to, it's worth nothing.
Nothing.
The first ratio we're going to look at is the current ratio. The current ratio is a liquidity ratio, something Lehman Brothers didn't pay attention to.
So the current ratio is going to be our current assets divided by our current liabilities. This ratio is used often because it's a good indicator of a company's ability to pay its short-term obligations. That means less than a year typically. So the first one that we want to look at is current ratio. So that's going to be our current assets, which is 73 billion and change, divided by our current liabilities, which is close to 44 billion. When we divide that out, we get a number of 1.68 as our current ratio. The next ratio we want to introduce you to is the debt to equity ratio.
The depth to equity. Depth to equity. You said depth, as in like depth. You said depth.
Debt.
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 Not depth.
The next ratio we want to introduce you to is the debt to equity ratio.
I don't know what I'm supposed to say. That's my bad.
The next ratio we want to introduce you to is the debt to equity ratio.
The debt to equity ratio can be found by taking total liabilities and dividing it by total equity. For our debt to equity ratio, if we take a look at our balance sheet, we can see that total liabilities equals approximately $83.5 billion. We would divide this number by total stockholder equity, the second line from the bottom, of $123.5 billion to get a debt to equity ratio of 0.68. Now, a high debt to equity ratio may not be a bad thing. It could just mean that the company is aggressively financing. It relates heavily to their capital structure.
Guys, we don't have time for that.
Fine.
Right. Come on, Steve. The next ratio we're going to talk about is the quick ratio.
The quick ratio is the current assets minus inventory divided by current liabilities. So again, this is our current assets of 73 billion and change minus our inventory of 1.764 billion divided by our current liabilities of close to 44 billion. We end up as a quick ratio of 1.64. Now this is important because it takes out inventory, which tends not to be a liquid asset. This means it is a more ideal indicator of a company's ability to pay its short-term obligations. Now let's talk about something that I really love, dollars and dimes.
Let's talk about the profit margin. It's one of the key measures of profitability for a company. It's found by taking net income and dividing it by sales. So if we move back to our income statement, we can see that our net income is around $37 billion. We divide this number by our total revenue, which was an astounding almost $171 billion, to get a profit margin of 21.67%.
Now that's some profit.
Now this takes into account all of a company's expenses, and it lets them know how they're doing within their industry. Steve, now let's look at some returns.
Mike, what return would you like to hear about first?
Let's start alphabetically. Start with assets.
Okay, so return on assets is simply our net income divided by our total assets. And what this tells us is how much income we are generating off of every dollar of assets. This is going to be our net income of a little over 37 billion divided by our total assets, which is 207 billion, and we end up with a return on assets of 17.89%.
Steve, it's also referred to as return on investment because it takes a look at net income, not sales.
Mike, we gotta get going.
Steve, we do. Kiara, take it from here.
Return on equity is net income divided by shareholders' equity. It measures how many dollars of profit a company generates with each dollar of shareholders' equity. And remember, we use these ratios to make informed decisions about an investment by comparing them to similar firms.